So, good day. Our topic for today is about project cost management. So, after this lesson, you will be able to understand the importance of project cost management, explain the basic project cost management principles, concepts, and terms, discuss different types of cost estimates, and methods for preparing them. Understand the processes involved in cost budgeting in preparing a cost estimate in budget for an information technology project. Understand the benefits of earned value management and project portfolio management to assist in cost control. And to describe how project management software can assist in project cost management. So as what we have here, this will be our additional learning objectives. Again, understand the importance of project cost management, explain the basic project cost management principles, cost estimates and methods, cost budgeting in preparing a cost estimate, benefits of earned value management, of course. Now, so what are the importance of project cost management? Just as information technology projects have poor track record in meeting project goals, they have also a poor track records in meeting budget goals. The Standish Group's Chow's studies reported an average cost overrun. The additional percentage or dollar amount by which actual cost exceeds estimates for unsuccessful IT projects range from 180% in 1994 to 43% in 2002. Although academic researchers question the validity of these numbers, more rigorous, scientifically reviewed studies still acknowledge the problem of cost overruns for IT projects. So, of course, what went wrong? So, as what we have here, according to San Francisco Chronicle's front page story, computer bumbling cost that state 1 billion. The state of California had a series of expensive IT project failures in the late 1990s, costing taxpayer nearly 1 billion. It was ironic that the state that was leading in the creation of computer was also the state most behind in using computer technology to improve its services. That is way back 1990s. So, what is cost in project cost management? A popular cost accounting textbook states accountants usually define cost as a resource sacrifice for or foregone to achieve a specific objective. So of course, Webster Dictionary define cost as something given up in exchange. Costs are often measured in monetary amounts, of course, such as dollars that must be paid to acquire goods and services. Because project costs money and consume resources that could be used elsewhere, it is very important for project managers to understand project cost management. Many information technology professionals, however, often react to cost overrun information within a smirk. They know that many of the original cost estimates for IT projects are low to begin with or based on very unclear project requirements. So naturally, there will be cost overruns, not emphasizing the importance of realistic project cost estimates from the outset is only one part of the problem. In addition, many information technology professionals think preparing cost estimate is a job for accountants. On contrary, preparing good cost estimate is a very demanding, important skills that many professionals need to acquire. Another perceived reasons for cost overruns is that many information technology projects involve new technology or business processes. Any new technology or business process is untested and has inherent risk. Thus, cost, growth, and failures are to be expected, right or wrong. So, using good project cost management can change this false perception. So, what is the project cost management? As we recall in our lesson 1 that the triple constraint of project management involves balancing scope, time, and cost goals. So in our lesson 5 and 6, discuss project scope and time management. In this lesson, describe project cost management. The project cost management includes the processes required to ensure that a project team completes a project within an approved budget. We notice two crucial phases in this definition: a project and approved budget. The project manager must make sure their projects are well defined, have accurate time and cost estimates, and have a realistic budget that they were involved in approving. It is the project manager's job to satisfy project stakeholders while continuously striving to reduce and control costs. Actually, we have three project cost management processes. Of course, the cost estimating, okay, involves developing the approximation or estimate of the cost of the resources needed to complete a project. The main output of the cost estimating process are activity cost estimates and supporting details, requested changes, and updates to the cost management plan. The cost management plan should be created as part of the project management plan under the project integration management. Number 2, of course, the cost budgeting. Okay? The main outputs of the cost budgeting process are a cost baseline project funding requirements, required changes, and updates for the cost management plan. The third, of course, is the cost control. The main outputs of the cost control process are performance measurement, forecasted completion information, requested changes, recommended corrective actions, and updates to the project management plan, of course, which include the cost management plan, right? Cost estimate, cost baseline, and organizational process asset. So, many information technology projects are never initiated because IT professionals do not understand the importance of basic accounting and finance principles, important concepts such as net present value analysis, return on investment, and payback analysis, which is already discussed actually in our lesson number 4. The project integration management, likewise, many projects that are started never finish because of cost management problems. So most member of an executive board have a better understanding of and are more interested in financial terms than IT terms. Now, therefore, information technology project managers need to be able to present and discuss project information in financial terms, as well as, of course, and technical terms. In addition to the net present value analysis, return on investment, and payback analysis, project manager must understand several other cost management principles, concepts, and terms. And this section describes general topics such as profits, life cycle costing, cash flow analysis, tangible and intangible costs and benefits, direct costs, sunk costs, learning curve theory, and reserves. Another important topic and one of the key tools and techniques for controlling project cost, of course, is the earned value management. It is described in detail in cost control. The profits, of course, is to increase, no? To increase the profits. A company can increase revenues, decrease expenses, or try to do both. Most executives are more concerned with profits than with other issues. When justifying investment in new information system and technology, it is important to focus on the impact on profits, not just revenues or expenses. Consider an e-commerce application that can estimate will increase revenues for actually around 100 million US dollar company by 10%. And you cannot measure the potential benefits of the e-commerce application without knowing the profit margin. So when we say profit margin, that is the ratio of revenues to profit. How about the life cycle costing? It allows you to see a big picture view of the cost of project throughout its life cycle. And actually, this helps you develop an accurate projection of a project's financial cost and benefits. No? Life cycle costing consider the total cost of ownership or development plus support costs for a project. Organization have history of not spending enough money in the early phases of information technology projects which impact total cost of ownership. The cash flow analysis is a method for determining the estimated annual cost and benefits for a project and resulting annual cash flow. The project managers must conduct cash flow analysis to determine net present value, and most consumers understand the basic concept of cash flow. If they do not have enough money in their wallets or checking accounts, they cannot purchase something. Top management must consider cash flow concerns when selecting projects in which to invest. If top management selects too many projects that have high cash flow needs in the same year, the company will not be able to support all of each project and maintain its profitability. It is also important to define clearly the year on which the company bases the dollar amounts. Actually, we have a tangible and intangible costs, and the benefits are categories for determining how definable the estimated costs and benefits are for the project. So, we have also what we call tangible costs and benefits are those or benefits that an organization can easily measure in dollars. While the conversely, intangible costs or benefits are costs or benefits that are difficult to measure in monetary terms. Direct costs are costs that can be directly related to producing the products and services of the project. You can attribute direct costs directly to a certain project, while the indirect costs are costs that are not directly related to the products or service of the project, but are indirectly related to performing the project. The sunk cost is the money that have been spent in the past. The learning curve theory is the state that when many items are produced repetitively, the unit cost of those items decreases in a regular pattern as more units are produced. While the reserves are dollars included in a cost estimate to mitigate cost risk by allowing for future situations that are difficult to predict. Contingency reserves allow for future situations that may be partially planned for reserve for times called known or unknowns and are included in the project because baseline. The management's reserves allow for future situations that are unpredictable or also known unknown unknowns. So as what we have here, no, we have when defect is detected. So this will be the typical cause of correction. So as you can see here, it's very important to spend money upfront to IT projects to avoid spending a lot more later. So this will be the definition that I will give you a while ago, the tangible cost, intangible, direct cost, indirect cost, and sunk costs. Again, sunk cost is money that has been spent in the past. When deciding what projects to invest in or continue, you should not include sunk costs. Of course, we have learning curve theory, reserves. Under reserves, we have contingency reserves or known unknowns and management reserves, unknown unknowns. The cost estimating. So, if they want to complete projects within budget constraint, after developing a good resource requirement list, project manager in their project teams must develop several estimates of the cost for these resources. Of course, an important process in project time management is activity resource estimating, which provides a list of activity resource requirements. It is important to know the type of cost estimates, how to prepare cost estimates, and typical problems associated with IT cost estimates. So, we have a types of cost estimates. No? One of the main outputs of project cost management is a cost estimate. The project managers normally prepare several types of cost estimates for most projects. Actually, the three basic types of estimates include the ROM, budgetary estimates, and definitive estimates. The rough order of magnitude estimate can also be referred to as a ballpark estimate, a guesstimate, a swag, or a broad gauge. This type of estimate is done very early in the project or even before a project is officially started. Project managers and top management use this estimate to help make project selection decision. The time frame for this type of estimate is often 3 or more years prior to project completion. While the budgetary estimate is used to allocate money into an organization's budget. Many organizations develop budget at least 2 years into the future. And the definitive estimate provides an accurate estimate of project cost. It is used for making many purchasing decisions for which accurate estimates are required and for estimating final project costs. So, we have here the number and type of cost estimate vary by application area. So, as what we have here, the Association for Advance of Cost Engineering International identifies 5 types of cost estimate for construction projects. A cost management plan is a document that describes how the organization will manage cost variances on the project. For example, its definitive cost estimate provides the basis for evaluating supplier cost proposals for all or part of a project. The cost management plan describes how to respond to proposals that are higher or lower than the estimate. So some organizations assume that a cost proposal within 10% of the estimate is acceptable and only negotiable items that are more than 10% higher or 20% lower than the estimate plan described in our project integration management. Another important consideration in preparing cost estimate is labor cost because a large percentage of total project costs are open labor costs, and many organizations estimate the number of people or hour they need by department or skill over the life cycle of a project. So, as what we have here, this will be the maximum departmental headcounts by year. So, a large percentage of the cost of many IT projects are human resource costs. Okay, so how about the cost estimation tools and techniques? So this will be the basic tools and techniques for cost estimates. We have analogous or top-down estimates. This techniques requires a good deal of expert judgment and it's generally less costly than others are. But it is also less accurate. Analogous estimates are most reliable when the previous projects are similar in fact, not just in appearance. In addition, the group's preparing cost estimate must have the needed expertise to determine whether certain parts of the project will be more or less expensive than the analogous project. The bottom-up estimate, sometimes referred to as an activity-based costing. The size of the individual work items and the experience of the estimators drive the accuracy of the estimates. If a detailed work breakdown structure is available for a project, the project manager could have each person responsible for a work package develop his or her own cost estimates for that work package or at least an estimate of the amount of resources required. Someone in the financial area of an organization often provides resource cost rates, such as labor rates, or cost per pound of materials, which can be entered into project management software to calculate cost. The software automatically calculates information to create cost estimate for each level of the work breakdown structure and finally for the entire project. The parametric modeling might provide an estimate of $50 per line of code for a software development project based on the programming language the project is using, the level of expertise of the programmers, the size and complexity of the data involved, and so on. Parametric models are most reliable when the historical information that was used to create the model is accurate. The parameters are readily quantifiable and the model is flexible in terms of the size of the project. Other consideration, of course, to make when preparing cost estimates are how much to include in reserves. The cost of quality described, of course, in the project quality management and other cost estimating methods such as vendor bid analysis and project procurement management. The computerized tools such as spreadsheet and project management software that can make working with different cost estimates and cost estimation tools easier. Okay, so we have what we call COCOMO by Barry Boehm. Okay, so the parameters include function points, source line of codes, and it suggests that only parametric models do not suffer from the limits of human decision making. Typical problems with information technology cost, of course, estimate are done too quickly, lack of estimating experience, human beings are biased towards underestimations, and management desires accuracy. It is also important to be cautious with initial estimates. The top management never forgets the first estimate and rarely, if ever, remembers how approved changes affect the estimate. It is a never-ending and crucial process to keep top management informed about revised cost estimates. It should be a formal process, albeit a possible painful one. So this will be the sample cost estimate. One of the best way to learn how the cost estimating process works is by studying sample cost estimate. Every cost estimate is unique, just as every project is unique. Before beginning any cost estimate, you must first gather as much information as possible about the projects and ask how the organizations plans to use the cost estimate. If the cost estimate will be the basis for contract awards and performing reporting, it should be a definitive estimate and as accurate as possible. So as what we have here, no? We have a Surveyor Pro project cost estimate. So we have the work breakdown structure items, the project management, the hardware, the software, the testing, and reserves for a total estimate. So for the Pro software development estimate, we have the labor estimate, function point estimate, total function points, and total function point estimate. This approach, of course, is based on COCOMO 2, default linear productivity factor, and penalty factor. The cost budgeting. Project cost budgeting involves allocating the project costs estimate to individual items over time. So these work items are based on the work breakdown structure for the projects. Because WBS therefore is required input to the cost budgeting process. Likewise, the project scope statement, work breakdown dictionary, activity cost estimates and supporting detail, project schedule, resource calendars, contacts and cost estimate, cost management plan also provide useful information for cost budgeting. The main goal of the cost budgeting process is to produce a cost baseline for measuring project performance and project funding requirement. It may also requires in requested changes to the project and updates to the cost management plan to help meet project cost constraints. So, as what we have here, most organizations have a well-established process for preparing budgets, no? So, they are required budget estimates to include the number of full-time equivalent staff, of course, often referred to as a head count. So, for each month of the project, and this number provides the basis for estimating total compensation cost each year. Then, a while ago, in addition to providing input for budgetary estimate cost, budgeting provides a cost baseline. It is the time-based budget that project managers use to measure and monitor cost performance. Estimating costs for each major project activity over time provides a project managers and top management with a foundation for project cost control. Cost budgeting as well as requested changes or clarification may result in updates to the cost management plan, a subsidiary part of the project management plan. It also provides information for project funding requirements. The project cost control includes monitoring cost performance, ensuring that only appropriate project changes are included in a revised cost baseline, and informing project stakeholders of authorized changes to the project that will affect costs. The cost baseline, performance reports, change requests, and project funding requirements are inputs to the cost control process. Output of this process are project management plan updates, corrective action, revised estimates for project completion, requested changes and updates to organizational process assets such as lesson learned documents. So this will be our example of a massive cost overruns can often be seen in the headlines of newspaper around the world. So in many articles will describe potential lawsuit of other legal action due to poor management and cost control of various type of projects. So stated here some few articles. No? Again, mention technical problems as the main causes of these cost overruns. How about the earned value management? Given a cost performance baseline, project managers and their teams can determine how well the project is meeting scope, time, and cost goals by entering actual information and then comparing it to the baseline. A baseline is the original project plan plus the approved changes. Actual information includes whether or not a work breakdown structure item was completed or approximately how much of the work was completed, when the work actually started and ended, and how much it actually cost to do the completed work. Earned value management was used primarily on large government projects. Today, however, more and more companies are realizing the value of using this tool to help control costs. In fact, an email discussion in late years by several academic experts in earned value management and a real practitioner revealed the need to clarify how to actually calculate earned value. So we have a planned value or the PV, formerly called the budgeted cost of work schedule, or also called the budget. We have the actual cost, total of the direct and indirect cost, earned value or EV, called the budgeted cost of work performance, work actually completed, and EV is based on the original plan cost for a project or activity and the rate at which the team is completing work on a project or in the activity date. The ratio or the rate of performance would be 50% because by the end of the week, the plan schedule reflects that the task should be 100% complete and only 50% of that work has been completed. Okay? The earned value estimate after 1 week is therefore, as of course, sometimes 5,000 US dollar. So, this will be an example for week 1. So, this table summarizes the formula used in earned value management. So, we need to take note that the formula for variances and indexes start with EV, the earned value. Variances are calculated by subtracting the actual cost or planned cost value from EV, and indexes are calculated by dividing EV by the actual cost or planned value. After you total the EV, AC, and PB data for all activities on a project, you can use the CP1 and SP1 to protect how much it will cost and how long it will take to finish the project based on performance to date. So we have here the formula for EV, CV, SV, CPI, SPI, EAC, and ATC. So we have what we call rules of thumb for earned value numbers. Okay, so negative number for cost and schedule variance indicated problems in those areas. Problem means the project is costing more than planned, that is over budget, or taking longer than planned, that is behind schedule. So as what we have here, we have an earned value calculation for 1-year project after 5 months. So this will be the EAC point above, and to the right of the BAC point measures the project is projected to cost more and take longer than planned. Of course, how about the project portfolio management? Many organizations have collect and control an entire suite of projects or investment as one set of interrelated activities in one place. So, a portfolio. So, project managers need to understand how their projects fit into the bigger picture, and they need to help their organizations make wise investment decisions. Many project managers also want to move on to the manage larger projects, become project managers, then vice president, and eventually CEOs. Understanding project portfolio management, therefore, is important to project and organizational success. There can be a portfolio for information technology projects. So, example, a portfolios for other types of projects. An organization can view project portfolio as having 5 levels from simplest to most complex, of course. So, as what we have here, we have the 5 levels of project portfolio management. So, what are the benefits of portfolio management? We have a meta group research shows and discuss the benefits of the said PM or portfolio management. Using project management software to assist in project cost management. So most organizations use software to assist in various activities related to project cost management. Spreadsheets are a common tool for cost estimating, cost budgeting, and cost control. Many companies also use more sophisticated and centralized financial application software to provide important cost-related information to accounting and finance personnel. So project management software can be a very helpful tool during each project cost management process. Actually, it can help you study overall project information or focus on tasks that are covered as specified cost limits. This will be the sample project portfolio on management screen showing project health. So we have here the effort base. No? We have the schedule variance and the project count. How many on target? That is 4. In trouble is 3. For the cost variance, the project count for on target is 3. At risk is 1. In trouble is 3. And we have a work ID and the project name here. So again, project cost management is traditionally weak area of information technology projects. No? Information technology project managers must acknowledge the importance of cost management and take responsibility for understanding basic cost concepts, cost estimating, cost budgeting, and cost control. Project manager must understand several basic principles of cost management in order to be effective in managing project costs. Important concepts include profits and profit margins, life cycle costing, cash flow analysis, sunk cost, and learning curve theory. Cost estimating is a very important part of the project cost management. There are several types of cost estimates, including rough order of magnitude, budgetary, and definitive. Each type of estimate is done during different stages of the project life cycle, and each has a different level of accuracy. There are several tools and techniques for developing cost estimates, including analogous estimate, bottom-up estimating, parametric modeling, and computerized tools. A detailed example of a project cost estimate is provided to apply several of these concepts. Cost budgeting involves allocating cost to individual work items over time. It is important to understand how particular organizations prepare budgets, so estimates are made accordingly. Project cost controls include monitoring cost performance, reviewing changes, and notifying project stakeholders of changes-related costs. Many basic accounting and finance principles relate to project cost management. Earned value management is an important method used for measuring project performance because earned value management integrates scope, cost, and schedule information. Project portfolio management allows organizations to collect and controls an entire suite of projects or investment as one set of interrelated activities. Again, several software products assist with project cost management. One example is the Project 2007 has many cost management features, including Earned Value Management Enterprise. Project management software helps managers evaluate integrated project data in a graphical format. And that's it for our project cost management. Thank you and good day, everyone. Okay, so once again, thank you and see you to our next topic. God bless everyone.